Welcome all, welcome all. This is actually the same week that SoFi has reported earnings. Although they reported on Monday morning, the last Friday at closed at $7.62. Much volatility, stock running up 24% on Monday, all the way back down. The stock closed this week at $7.88. Looking at about a 16-cent increase on these earnings.
SoFi stock over the past 5 days is down over 10%, down over 10%. If you looked at what SoFi closed on last Friday, it was around 765. If you looked at what it closed today, it was around 788. If someone were to zoom out and look at this thing on like a yearly basis, not one person could point and tell me, oh, this was actually the turning point when the company turned profitable. Not even a blip on a weekly basis.
Sure, yeah.
It is divorced from the fundamentals at this point. It can go, broken stocks. Typically, we're talking about them on the downside. And we know like the stock is a different animal than the company. The company, you know what you're going to get every single earnings. They just execute. Fantastic. The earnings call was well rehearsed. We already went over that. And so you know what you're going to get with the company. You know what you're going to get with the stock, and it's volatility. I was hoping to touch 811. I was wrong on that one, guys. I'm sorry. And I was really hoping this would be the time that GAAP profitability would say, okay, no, this stock is serious, this business is serious, but it's disrespected by analysts.
Palantir, I think, took 2 quarters. The second quarter, it just doubled.
2 quarters and the headwinds changing to tailwinds. The AI just push from ChatGPT. Yeah. I think fintech will have that possibly this year, but if we get that, maybe another quarter and some tailwinds instead of headwinds.
Like I was buying this week, I was buying last week, I bought more today. I think I bought 2 times after earnings came out. What I got, I'm going to keep buying.
On that note, so you're hoping it goes to 5. What if David Chiavarini or whatever his name is, but what if he's right? It goes to $3. The macro has not changed, and there's nothing changed with SoFi. How heavy would you buy that dip?
I mean, I would seriously consider selling some positions and moving additional money. And right now, I'm only buying with new capital. I'm not selling anything to buy. If nothing changes with the outlook and this continues to slide and you get into like the 6 area, I mean, I would definitely consider.
If this thing goes into the 5s or 4s on camera, happy to say it, I'm probably going to be selling every single thing I have and just going all in, or just maybe SoFi Tesla 50-50.
I was going to ask, would you sell Tesla?
Yeah.
Really?
I would definitely sell good chunks of Tesla. If nothing in the fundamentals change, if nothing in the macro changes, it's just a overreaction. It's just silly not to, man. Because okay, look, the fact of the matter is some people will make outsized bets on SoFi, will be gambling with money that they can't afford to lose.
They shouldn't do it.
They shouldn't. And I agree with you. They shouldn't. But people are people and people will do dumb things. Yeah, these are all great arguments. But here goes another year, basically. The opportunity cost is gone. It reminds me of that Tesla moment in 2020 where this thing was flat for like 10 years and then it just did a 10x.
Hey, are you a trader or are you an investor? Because if you're looking for opportunity cost, you're going to go with whatever's going to get you the most alpha in a short period of time. But if you're an actual investor, you should have a 5 or 10 year horizon in your head.
Sure, absolutely. This thing can stay depressed for another 5 years. It could go to a 3 PE. My point is that a lot of people are getting demoralized because they have expectations on the stock to do something, to be attached to the fundamentals, when in reality, all I'm pointing out is that those expectations are the primary source of your dissatisfaction, because the stock can stay detached from fundamentals for longer than you would initially think.
Markets can stay irrational longer than you can stay solvent.
But at the same time, people should not have unrealistic expectations. And that's a personal problem. Once again, I don't care about what other people's expectations are. I don't care about other analysts. I am looking at this from a logical standpoint.
The one thing for me that made it a 10 out of 10 earnings was the fact that Anthony Noto gave us guidance through 2026. What do we know in 2026? We know that their stock options are going to vest. It was timely because it made me think about this entire court case with Elon and the commentary around that, how it was this ridiculously aggressive comp package that no CEO out there would even take. Nobody would say, okay, let me not make $50 million this year. on the off chance that I can 10x my stock and get $50 billion. Nobody would say that, okay? Anthony Noto provided these targets. And in addition to that, provided a product roadmap that includes SMBs, that includes all of these different aspects of how they can grow their business to 2026. At the end of the day, I think that he's the only other example I see where a CEO is tying their net worth to their performance through those PSUs. The shareholders are direct beneficiaries of Anthony Noto hitting those targets. For 2026, David Cavarini can say it's aspirational. Morgan Stanley can say there's execution risk. There's no company in the world that does not have execution risk. But if I'm thinking about what is the company that I want to put my net worth behind, I really want to put it behind people that back themselves and that have the confidence to do that and that have the confidence to put their skin in the game. Realistically speaking, I know Anthony Noto is going to do everything in his power to execute because he makes like $300 million if he does. I want to be on the back of that to ride those coattails.
A lot of what I'm reading that IP is sending me is just the fact that they don't believe what Noto is saying for their 2026 guidance. A lot of it is your 2024 guidance does not look great. We don't suspect great growth here. So how are you going to squeeze out even extra going out into 2025, 2026 if we're getting into lower rate environments and coupon rates are cutting and you're not going to be able to generate as many profits from their lending segments?
What is the thing that separates this game from a casino, right? It's that predictability. And the fact of the matter is, I place a higher degree of confidence on SoFi's management when they say something because they have a proven track record of having backed up what they've said in the past. The fact of the matter is that Anthony Noto has held true to all of his promises. And for over 2 years, SoFi has always beat on revenue, beat on the EPS, and always raised guidance. And they did that for 4 quarters out of 4 quarters in 2023. As a result of that execution, it lowers my risk in believing every future promise that he's going to say until he starts missing promises.
Sandbagging guidances can only lead you so far. If you continue to do that for so long, it can actually kind of have a negative effect because you're saying what's happening into the future is not going to be exciting as what we just put out. Do you think that there could be a possibility, and I'm playing devil's advocate here because I'm looking for answers, but do you think there could be a possibility where SoFi always hangs out around near fair value or below because there isn't guidance, which is expecting high growth rates?
I mean, I don't know what earnings people saw, but they gave pretty high growth rates through 2026 and beyond. So
I'll share my screen because this is what Compass Point was looking at whenever they were putting a $4 price target. But what essentially they were looking at was lending growth would be around 92 to 95% revenue for next year, or a 6.5% decrease. Financial services would see a 75% increase, and technology platform would have around a 20% increase. Corporate revenue, I just put as what it was for most of the years before this last year. This last year kind of had a benefit in the last quarter. It was kind of breaking trend, but let's even say that that was zero. That would place SoFi's growth for next year around 13 to 15%, much, much lower than their last year of 35%. One thing B-Dubs brought up to me was the idea of 50% from lending and 50% from the other two segments. If lending will contribute $1.25 billion, then that would actually put total revenue at about $2.5 billion, somewhere around there.
And that's only assuming that lending is actually down 6.5%, which I think it's actually going to come in up single digits.
I totally agree with you. But this is what I think the street is seeing because SoFi is giving these more conservative outlooks quarter after quarter.
But even this week, we had an analyst come in and basically disbelieve the numbers that SoFi was putting out. And they said, no, these are way too high. There's no way that they'll hit those. So you can't have it both ways. I mean, if you sandbag, if people are like, no, those are way too high, it's like, what are you talking about? And then somebody else on the other end is like, okay, yeah, you're sandbagging, quit doing it. Otherwise, we'll actually believe you and we'll rate you that way.
Right,
so
right.
I don't know what the answer is there.
Let's just say that 50% comes from financial services and technology platform put together. Then all of a sudden you could have a world where, you have 2.6, even something, higher. That 35% can very much stay intact. And the amount of time where an analyst needs to see the actual results in print, and us as retail, we can forecast out and we can say, okay, well, here's the trend. Let's just extrapolate that trend. That's alpha, right? Like that is an amount of time that we can accumulate and take advantage of the stock being depressed.
the majority of analysts are missing the bigger picture with SoFi. I could lose every penny that I have invested in SoFi. It would suck, but it would not kill me. People should not invest what they can't afford to lose. And that's one of the reasons why I'm very diversified, because I protect myself from myself. People have to start actually thinking outside the box. When I say people, I'm saying these analysts who are looking at just the same thing that they always look at. The bottom line is all these banks have to upgrade their architecture. Like, that's non-negotiable. There's new compliance laws that continuously come out, especially with all the cyber attacks. There's so much that's going to happen in the next 5 years. To think that SoFi's platform is not going to be powering a small percentage of their competitors is kind of crazy to me. The members from SoFi are the only ones that matter. I don't care what one analyst versus another analyst thinks about SoFi being able to continue its growth rate if the bank is relevant. Guess what? Their freaking deposits grew by 156% this year, year over year. Their members keep growing. Obviously, people are finding value in it. Whether these analysts are finding value in it, I could give a shit. Don't care. I truly believe that he is giving guidance because he is sick and tired of people doubting this stock. And even if you come in at the low end of this, based on 2024 through the low end of 2026, SoFi is trading at 15 times 2026 earnings, and that's at the freaking very low end. If they even come in, let's say they come in the middle at 70 cents, they're trading like a tobacco company. All right, so 0.8. Still trading at less than 10 times forward 2026 earnings. For SoFi's growth, I don't think that they should be trading at 10 times earnings, forward earnings. Eventually, I think there's a higher probability of what I foresee as a bull thesis playing out than a bear thesis. Because if the bear thesis was going to play out, it would have played out in 2020 and 2021, but it didn't. So how on earth is SoFi going to go under if they manage their way out of the worst economic cycle that they could have faced, with their largest business segment being crippled, and they managed right through it?
They've had multiple instances where they've pivoted or where they've come out on top. Every subsequent quarter that they triple beat, I build my confidence a little bit higher in management. And people might be saying, oh, like, why is Tev giving Anthony Noto so much grace? It's because he's earned that grace over the past 2 years. And simply due to the PSUs, again, going back to the entire argument at the very beginning, like the incentivization that does for them to reach their tranches, that's mid 2026. And the stock has to stay within these tranches or above them for 90 days. The tranches are $25, $35, and $45. 2026 is only 2 years away. If you take SoFi at $7 right now, that's anywhere between a 3.5x to over 6x on the high end for those tranches. And so if you look at that in a 2-year time span, for you to expect a 3.5 to a 6 times return on your money.
2.5. June 2026 is when they vest, I believe.
2.5 years. Yeah. Sure. But my point is that is a very tantalizing risk reward for me to say, okay, I can make this bet today so that in 2.5 years I can get a 3.5x on the low end. Yeah.
There's nothing new with the bear thesis, and everything that they keep coming out with continues to get disproven.
They continue to say things about SoFi, and SoFi disproves them again and again and again, quarter after quarter. The management has excelled. And just like Tevis said, I ended up going in heavy at SoFi just because of the management. I was like, okay, this is an amazing company. I've been tracking for a while. As it continued to fall, and the more and more they executed, I'm like, okay, I just believe them. If they throw out a number, maybe they're sandbagging it, but if it sounds lofty, like, they're going to hit that. They're going to do that. I don't know that they're going to hit 25 or 35 or 45. I do know this company is going to execute. They can only control the company. 2.5 years is really, it sounds like a long time, but for a business, it's actually not a long time. But they're doing phenomenal. And I don't see any personal reason why all of those numbers would not be conceivably in play at this point.
What this earnings has ensured all investors and, the 400 plus people watching, it has given you confirmation of profitability and has allowed you the opportunity to buy the stock at nearly the exact same price than you were before you had that confirmation of profitability. And so essentially, you just got free information to buy SoFi at what people were buying it 2 weeks ago when it was a question mark. Are they going to be profitable or not? And that, I think, is a really huge gift that the market has given you in the short term.
Breaking news, ladies and gentlemen. Breaking news.
What is this?
Macro Steve. The FOMC meeting had just recently happened this week, as well as a jobs report. This could deal in heavily with how SoFi might be treated by analysts and other retail investors. We need clarification. What did Jerome Powell say about the March meeting, and how could this impact SoFi's loans?
Since last year, nobody has taken Powell seriously. Continuously, I have said this is not what he has said. You can go back to my articles. You can go back to when I went on Finance Junkies and said it. Everybody who said, oh, he's cutting last summer. Oh, he's cutting in September. Oh, he's cutting in October. Didn't cut. Wasn't going to cut. That's never what he said. He took as much as a victory lap as he could at this meeting, and he made sure that everybody knows, yes, the situation is getting better. Yes, we understand the situation is getting better, but it's not where we want it to be. And we're not cutting in March. Get it out of your heads. Unless he is just being ultra conservative and has the best poker face in the universe, there is basically no chance he cuts in March. It is more likely they're cutting in May or June because he said. The reality is that they're probably going to cut 3 times this year. The market has been pricing in 6 cuts. And quite honestly, the economy is booming. It would have been horrible for him to come out and cut this week. And it probably would be bad if he cuts in March. You don't cut rates when the economy is booming. But there's a flip side to that. There is a debt problem.
What did you think about the jobs report in terms of expecting 185,000 new jobs? They saw 353,000. Unemployment rate remained at 3.7%, under their expectations of 3.8%.
Yeah. I mean, look, employment is good. Like, employment's good news. But at the same time, you got to be a little bit careful with it because the economy is running hot, and that could extend it. But back to the credit thing, I would rather say the Fed stay at 3% and cut or increase based on an as-need basis. Because right now, what they're doing to the country right now is crazy because we're paying more in interest on the national debt than the military-industrial complex budget. Having rates this high has ballooned our interest on the national debt by, it's over $800 billion right now. That's crazy. You also have many Americans that are hurting because interest rates are so high, and that is prohibitive and restrictive. I get it. The guy doesn't want to necessarily cut because when money's cheaper, people spend more money, and he, rightfully so, is afraid of inflation creeping back up again. That's the last thing they want because of all the work that has gone on. He's taken us to a soft landing, right? The soft landing is happening.
Especially with this jobs report on the idea of potentially no March cut. How do you guys feel this impacts SoFi whenever their expectations are considering 4 rate cuts this year, a 5+% unemployment rate by the end of 2024? Does this mean that potentially defaults might be lower than expected, but also rates might be higher, so harder to sell loans? Or how do we think about this?
If you get 5% unemployment, you're going to get more than 4 rate cuts. If you stay, with really low unemployment, anything can happen as far as the rate cuts. It might be 4, whatever. So both of those things are not going to be true. But they're guiding it so conservative that they're actually saying, hey, our lending platform is actually going to shrink. In this scenario, it's going to help them far more than it hurts, if it even hurts them at all, because we're not actually increasing rates. People know it's like, hey, this is the way it is, higher for longer. Okay, some people have to buy homes. Some people have to buy cars. Student loans are coming back. And I do expect that Q3 of 2024 is going to be an absolutely phenomenal year, no matter what the interest rates are at. But bottom line is, if people have good jobs, I believe that the average wage was up 4%.
I mean, enough with this. Let the free markets fix themselves. Don't play around with rates unless you absolutely have to.
The BTFP program, I think they're ending it in March,
Yep.
I believe. I would actually like to see a rate cut in March just because of that, just to ease a little bit of pressure, just in case, so they don't have to cancel a program, bring it back if there's pressure on banks. SoFi, I don't think would be affected either way, but that I could see as something that if banks start to topple, like Silicon Valley Bank last year, that could cause a lot of pain for us as holders temporarily.
First of all, on the macro, like, we're not getting 5% unemployment, man. Like, it's not going to happen. It's an election year. Like, you're going to get a pump fake from January numbers because UPS laid off 12,000 people. City's going to lay off 20,000. and it's going to seem really bad, but then number of layoffs is going to normalize throughout the year. I just don't think you're going to get like that high unemployment. Like it's going to be higher for longer probably than what the market expects. The market is always going to be hopeful. You know, the unemployment numbers, I think, in SoFi's estimate are just way too conservative. Did you guys see the NYCB stuff? It just cratered this week.
Yeah, I'm pretty pissed off at management right now.
Did you
Shareholder?
own that?
Not a lot, but I do own it. I actually bought some today as a trade, some additional as a trade.
Yeah. Not a lot, like 40% less now, right?
Yeah, it took it. Listen, but these morons could have done a better job at guiding last quarter, and they could have said, "Hey, we've never operated at over 100 billion in assets, and we need some time to figure it out." They took over Flagstar, they took over Signature, and it put them into a different category. And they freaking didn't do their math correctly, and they need to cut the dividend to build the reserves. Like they could have warned about these things, and quite frankly, they shouldn't have waited till earnings to drop this bomb. They should have pre-warned, is what they should have done.
New York Community Bank, like he said, acquired a bunch of companies while banks were in hard times. One of them, they bought a ton of assets from Signature Bank. Well, actually, they got them off of FDIC directly, and that took them over the $100 billion in asset mark, which actually adds more regulatory scrutiny. Instead of doing 28 cents of EPS, they actually reported negative 36 cents of EPS, I think is the number, if I remember correctly. They took on $500+ million in losses that they did not expect. Weirdly enough, it was only from like 2 extremely large loans. They cut their dividend from 17 cents down to 5 cents, which is like a 70% cut there. And they got obliterated, which
rightfully so.
Rightfully so. But bringing back the talks of, are we going to head back into a banking problem? And then in a couple months, this sort of a new program that was designed to help alleviate some of that pressure from the banks was the Bank Term Funding Program. And now they're removing it in March.
So I want to read something from their earnings call. Okay.
Please.
This is from the second paragraph in their earnings call. Quote, "We reported 2.3 billion in net income available to common shareholders, up from 617 million in 2022. We significantly diversified our balance sheet with commercial loans representing an increasingly greater percentage of total loans." They start the conference call off with highlights and achievements. So
that was for this quarter, you mean?
Yeah.
That's hilarious.
So you made 2.1 billion in net income, and you guys aren't smart enough to know what's going to happen when you make these acquisitions. Like, it makes me question management. Like, what are you guys doing? Like, how do you not know the ramifications of growing?
They also, very much like a traditional bank, unlike SoFi, saw a decrease 2% quarter over quarter in deposits as well. 1.3 billion down. I wonder if now that they've reported these bad earnings, does this start to cause panic of people saying, hey, I don't want to be where these Silicon Valley people were, where Signature Bank people were, where First Republic people were, and I'll just get my deposits out now, which might cascade this problem.
On Monday, SoFi announced alternative assets. It's just another offering for SoFi Invest members, the alternative assets. Essentially, ARK Venture Fund is a part of this. There's also funds that are pre-IPO companies. There's funds that's real estate. There's mutual funds. I think it's initially starting at over 6,000 different funds.
This is coming soon, but a lot of people have gotten access to this.
So again, I chalk this up as, great news because it's, again, more competitive advantages from a product perspective that separates SoFi Invest from other brokerages.
So 2 things. The first thing is alternative assets, which is great because some people want the ability to invest in companies like Stripe, SpaceX, those types of companies. And while SoFi is not using a proprietary ETF, it at least allows individuals to purchase and hold this in their account on the SoFi platform. And with SoFi having a younger demographic, these types of things could certainly entice them. I am more interested in the 6,000 mutual funds, because this is huge. The 6,000 mutual funds goes right into my thesis of an asset management arm, because the very next thing is going to be they're going to have their own proprietary mutual funds, just like they have their own proprietary ETFs, and it makes them much more suitable for pension funds and 401ks from companies to have on SoFi, and SoFi can then double dip because they'll get that asset management for assets under management on the actual fund at the 0.07% or whatever they're going to charge. They'll get the actual fund administration fee for having all the funds on their platform.
Steve, I knew you were going to talk about that. So this is a tweet that Chris Hager made on Monday on Anthony Noto's 2026. This is Anthony Noto. For the 2023 through 2026 time period, we see 20 to 25% compound annual growth, assuming no meaningful change in the macro, blah, 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 and no significant business launches or acquisitions, such as like, hey guys, wink, wink, nudge, nudge. We will not do these things if we want 20 to 25%. Small, medium business checking or savings. Number one, small and medium business lending, broader asset management business, insurance, broader credit card portfolio, new technology verticals for the tech platform business, new geographies. And so this is essentially the product roadmap for SoFi that they said, if we assume 20 to 25%, it has none of these things. This is why I'm so bullish on the 2026 phrasing that Anthony Noto said, because if you read between the lines, he's basically saying like, hey, these are the things we already are thinking about right now in terms of expansion until like over the next 2 years.
Think about it like this. They've been able to get to where they are without business. These things are coming. I would be shocked if they're not here sometime in 2025 or late 2024. Okay, I would really be shocked. The guy is basically telling you what they're going to do, and it's everything that we've been talking about. And this is how they get to the next level. And you make this where small and medium-sized businesses have an outlet to utilize SoFi. They are going to gain tremendous amount of customers. And then you couple that with the asset management firm. And this is how they get to be a top 10 financial institution. We have said it time and time again, and these analysts are not looking at this.
I
Go ahead,
knew
Roy.
in that moment, I was like, okay, Steve's got to be smiling because small and mid-sized businesses, top of the list right there. And of course, you know, it was either a week or 2 weeks ago, they rolled out the third-party loans to the small businesses, small and mid-sized businesses. So they're heading that direction. You know, question is when, but it's not a question of if.
I'm curious to know if small to mid-sized business accounts will be accretive to their growth at the start. You look at their invest platform, you look at their credit card platform. These are major losers to their business right now. $100 million a year.
100 million, yeah. They're still losing, yeah.
There's roughly 33.2 million small businesses across America that employs just over half of all employees across America. But half of U.S. employees are employed by small business. When you add small and medium size, this is a gigantic opportunity.
And especially, I think that the opportunity for small to mid-sized businesses, especially with Galileo, like they offer all of these different, you know, payment platforms and bill pay and card programs and corporate card programs that they could literally just offer to their SMBs for free. That's the one thing that I think is really, really exciting, is that we would have a better offering than most. It's an area that SoFi could build out. I just don't know if it would be additive to the business, or if they're building it on Technisys, is it just almost immediately accretive? So that's not something that I know.
Think they're building it right on Technisys. And look, the partnership with MasterCard for management spend is huge. Anybody in the chat that is in business or has corporate P cards will completely understand how important that is to a company. This is a fully vertically integrated company. They're going to have an offering for everything eventually.
If SoFi puts out level 1 options, what are they missing at that point? I'm curious to know, because I don't have access to Robinhood.
It's incrementally better, you know, with alternative assets, the level 1 options. I know a lot of people actually are asking for that, and I've seen some of my my ex-friends that I know are legit investors that they are going to move out of SoFi just because they feel like they're missing out a lot on level 1 options. I think it's the UAI, honestly. Like the product will continue to improve. It's all right. It's not their best product offering at all. I've never been particularly excited on it. Robinhood's just a lot better. As wages continue to improve, you know, people will be like, okay, maybe I should invest a little bit. That's how it begins. That's how they get you. In this case, SoFi, you know, they're trying to help you get your money right. It's kind of beneficial if you're a new person to not have the level 1 options, but they need to take that off. And so hopefully it does come out this quarter. They will lose some people if they don't roll that out fairly soon. But still, it's the UI.
Asset management arm is way more important than options, but I do see the benefit in adding options because selling covered calls or writing cash secure puts is becoming much more normalized in 2023, 2024 than it was just 2 years ago. And that is a differentiator that would make somebody go with Robinhood over SoFi. So just from a pure competitive standpoint, it is important. But if I had to pick one or the other, I would rather the asset management arm than level one options. But I want both.
Ladies and gentlemen, that's been the SoFi Weekly.